So I thought I'd walk through the various CTs, cumulative tick scans that we're seeing, screens that we're seeing right now. So the first one here is with USC. So this is the US composite. This is the kitchen sink. This includes all of the regionals, and really it is the early warning system for the cumulative tick system. There's a couple things going on here that I think are useful. Now we also include on the trade station screen, 52-week new high, new lows, and you can see the new lows have been dominating. They did start to drop on Thursday, Friday, and actually today, for the first day in a long time, we're actually seeing breadth measured by the 52-week new highs slightly outpace the 52-week new lows. Put that as a data point. That's a good thing. Next thing to look at is what we call the filtered cumulative tick. The filter triggers anytime a bar closes, bar being 1 minute in length here, and it shows effectively if the amount of volume, net volume on the exchange in terms of ticks is greater than 1,000 to the upside or 1,000 to the downside, it starts incrementing. And right out of the open this morning, we saw some pretty serious buying, and we tend to think this is institutions, the big boys and girls doing what they're doing. And you can see it as soon as they cleared their book over the 3-day holiday weekend, it went flat. And that is normal. Once they had adjusted their risk for the morning and done so in a way that you can see how price behaved in this, then it was what it was. So we're now kind of floating. No major directionality. We're not seeing any sell-offs to the zero line. We're not seeing any linear up pushes to the north, and so we're kind of just meandering. And you can see this is the unfiltered version of that right here. And what this effectively is telling us for the day, we're more or less flat. And so no real pressure one direction or the other. On the lower half here, and this will be common to the rest of the cumulative tick slides, so we have what we call the ribbon. This is the historical moving averages. The slowest is on top. It's cyan and all the pictures you're going to see from me, and red is the fastest. And basically when cyan, the slowest MA, is above the fastest MA, we're in a downtrend. Now you can't really see it here, but the slope is pretty significant. The lines are parallel. We have been in a downtrend. We remain in a downtrend, and we use this as a long-term trend indicator effectively. And the only way that this long-term trend indicator reverts is if the short-term cumulative tick, which is this bolded white CT line that you see here, if it goes above, it'll start causing a reversal here. Now, why is this important? Because the bolded white CT, which is the same as this line here, effectively measures the instantaneous. It's not delayed. There's no hesitation in the presentation of the signal. It displays what is happening in the industry. And why that's important here is that we do plot some short-term moving averages. When it moves above those short-term moving averages, you can effectively say relative to recent history, it's showing a change in sentiment, and everyone should be paying attention to that. The flip side of it is that when we drop below, and don't read anything to bouncing, that has nothing to do with it. It's more on the price action. When we see lower lows being put in on the CT, that's indicative of net selling on the day, and you can actually see the correlation between what you see here, price action, and the institutions. So all in all, the USC early warning system breadth is looking better. I like that. In terms of an entry signal, many of our users will take this that we're above as a potential to enter. I don't like entering in the first 15 minutes for the reasons you see right here, especially after a 3-day weekend and knowing that the book has to clear. A penetration of the short-term moving averages can be taken usually as a risk-off signal, that you could actually get a reversal. So I would be very, very cautious of this. I am not a 0 DTE guy. I'm not an intraday trader. I am not flat at the end of the day. So I tend not to look and try to time the explicits. I look at the end of day, and the end of days are important for me because I spend a lot of my effort back testing end of day signals for 10 years, et cetera, et cetera. And so I'm looking to see what are the longer term trends, not the instantaneous short term trends. That being said, great entries can be achieved if you are a 0DTE trader or a short-term trader. As you cross these moving averages, as you get a confirmation of the crossings, and as you remain above, these can be wonderful places to enter in and potentially scalp some trades. The next slide here is of the tick RC. This is the ARCX. The ARCX is comprised of three exchanges. It's the NYSE, the New York Stock Exchange, the NASDAQ, and the MX. And the MX actually contains a number of classes. It contains your options, it contains your ETFs, and it contains stocks. So we see, though, that those are all high value exchanges, meaning you have to pay to play on those exchanges and transact on those exchanges. And why that's important in the big picture is that you get a different presentation than what you get in the USC. So same opening, we had the gap up, we jumped up, we've come down here, of course, you can see that, to whatever levels, and now we're starting to see some adjustments. I would think this is in part into the Euro close, which is going to be at 11:30 Eastern time. It's coming up here shortly. But frankly, the CT in this never really pushed higher. It turned up from Friday, and this was the end of day adjustments that we saw after the JPM and going into the 3-day New Year. But you can see we've actually started to fail, and we're right at where we opened for the day. So in overall strength, we're not there. We're not seeing it. What we want to see is either an intraday reversal where we just continue pushing north and don't get this fading that we're basically seeing in price and here. And then, of course, breaking below those shortest term moving averages can give you an indication of sentiment change on the shortest of time frames. Long-term time frame, you can see very clearly long-term downtrend. It remains, it's going to remain, and this basically is telling us, without any knowledge of gamma or delta or any of the other tools that we have here, this is basically telling you to sell the rips and buy the dips because you are in a long-term downtrend. All right, so this is the tick RC, which is the ARCX. Let's go look at the SPY. So this is tick SP. Tick SP is, as you would imagine, it's the S&P 500. And what I look for here is I'm looking for that the shape of the price of the S&P 500, this is actually the SPX, and the shape of the CT are not divergent. I want to see roughly the same behaviors. And you can see for the most part, we do see that. Although I will state, it looks like, we're making more lows, et cetera, et cetera. This is on Friday's action. We get that reversal, boom, we get this, you get that, and then up into the close, we finish high on price, although there was some selling as we go higher in price into Friday's close. So let's look at today. We have the gap up. This picks up where Friday left off. We hit a peak. We come on down, you can see they're coincident, and now we run up. Yep, so that was clear buying, no question, and now you can see the selling is reflective here. So it'll be interesting to say, you can see price actually is lower, but the CT is not showing the weakness that we see in price. So in terms of the buyers, there's more net buyers in this up leg than there were, although price, this is dealer adjustments. And remember, we presume dealer adjustments. Dealers don't care about price. So this is just the dealers getting less long or getting shorter as they're selling to hedge flat. And you can see that in the overall CT presentation. We got a higher low here, and I think that's actually constructive. So I'm watching this for a potential entry. You can see we're now in the noise of the, where we've been. These MAs, they're trying to turn themselves up. We're not making the same lows that we were making here, right? So just be aware that the SPY is looking fairly constructive, noisy, choppy. This is a very choppy signal today. Not a lot of pressure, and we saw the not a lot of pressure here, right? So you get it. But nevertheless, we're not making lower lows. Chalk that up. Let's look at the Qs. Qs are the same thing. So this is the NAS 100. I use the ETF QQQ for that. And you can see actually, we were in a downtrend, and then you can see over the last couple of days, the downtrend is starting to abate. Part of that is price and the CT are moving up into the ribbon. And you can see today, for technology, which the Qs represents, we're actually flirting above. So you can see what's happened here. As soon as the CT starts pulling up into the ribbon, we get a slope change. This actually is a bullish type of indication. If you are willing to take a little bit of risk, this is telling you that there is some acquisition of risk in terms of technology plays in the Qs. And this could be, again, for your paper trading portfolios, this could be a very interesting area to start increasing your exposure to the Qs and perhaps to the leadership within the Qs. You can see with respect to Thursday, we continued. Friday was pretty much horizontal except for that end of day adjustments in the market, which is what we have here. It's kind of the same animal here, right? But you can also see we're kind of bounced. Price is lower, the CT is not. So we're flirting right with this upper range. Why I like this from a technology perspective is that if we can stay above the cyan line, which is the slowest moving average of the ribbon, it will start to turn the nose of the ship upward. We are starting to see bullish type of tendencies, not in the broad market. We didn't see that in the USC, right? We're still kind of flirting below. We're in this downtrend. Even in the quality, the ARCX, we're in a downtrend. CT is not participating. So broadly speaking, we're not seeing a participation in the broad market of quality stocks. The SPY, a little better, a little improved. The Qs, even better, right? Starting even higher. And I think that's constructive. And then finally, the last one I look at is the tick RLC. Now, the reason the tick RLC is important in this context is that this is the Russell 2000 small caps. And you can see, first of all, auto scaling is why this is so big here. It's been, effectively flat. And when it's flat, the ranges open up and an auto display on the overall screen. We've been going horizontal. We've been horizontal for a long, long time. In fact, if I drag this thing back, you can see the CT is just flat. Price is doing whatever it is, but there's not been any progress. So if you do follow price and you ignore the CT, you do so at your peril, because price is not 100% of what matters here. It depends on your time frame, but I want to be very, very clear. If the CT is not advancing in a linear up or a linear down manner, price is going to be choppy, and you better shorten your time frame very, very tight. And frankly, with what we're seeing here, CT is very tight. The market within the Russell 2000 is very choppy, independent of price, and I think it all plays itself out. So the takeaway from looking at the Russell 2000, small caps are not participating. They haven't been participating. And until we start seeing some, hard directionality here, one way or the other, it's going to be very, very hard to break out. So all of that said, you can see we're now up in the ribbon. We're going to start getting the shortest moving average of the long-term ribbon starting to turn up if we can get any positive progress in the CT. If we can't get any positive progress in the CT, then we're going to be basically heading down. We're going to break this red line coming down, and we're going to be back into business as usual. And then I would be a seller of IWM. So there was a question effectively asking, do I see entry levels for today? Well, certainly any time, depends on your time frame, of course, right? I don't see anything long term. I see constructively For the cues, perhaps, if you were playing back here, perhaps you're doing fairly well. Of course, price-wise, you're underwater, and price is what we transact in. But the longer-term vision here is that we are seeing some thawing in the cues, and perhaps any of these pullbacks you would want to go to the long side, again, in your paper trading portfolios. The SPY, any of the pullbacks also could be constructive to the upside. I would not get large here though. We're still long-term below. We're unable to really push aggressively higher, and the quality that we're seeing is actually weak. The quality stocks here are weak, and this is the ARCX showing us that effectively we haven't put in Friday's low in terms of net selling, but we haven't also advanced upward. And I like to go long on a pullback when the CT is advancing. The CT is not advancing. So pick your time frame, pick your instrument, and align your interpretation of the CT, whether it be using TradingView or TOS or TradeStation. Those tools are available, and you should be able to start learning how to interpret and where your possible entries could be. Just wrapping up this last one. So this is the USC. We're back to where we started here today. Not seeing any pressure here. Are seeing some weakness come down. We're almost right at where we started the day. So it's kind of a net blah day. I'm not seeing anything that gets me excited for going in. So until I see some directionality, I'm probably of the mindset that the short-term direction is down, and could potentially play some of those failures. But again, you need to pick your time frame, pick your instrument, and see how your instrument is performing with respect to the CT, and then go from there. So hopefully this was useful.